when you finally swap your work badge for endless mornings with coffee and crossword puzzles. The last thing on your mind is withholding taxes. But come April 15th, the IRS will remind you otherwise. When you retire early, your employer stops pulling federal and state taxes out of your paycheck. Yet most new retirees forget to set up estimated tax payments on their IRA distributions, pension checks, or even the small slice of Social Security that's taxable. You cruise through the year enjoying freedom, only to discover your 1099s add up to zero withholding. That's where the underpayment trap snaps shut. The IRS requires you to pay at least 90% of your current year's tax liability, or 100% of last year's, 110% if you made more than $150,000, through either paycheck withholding or 4 evenly spaced estimated payments. Miss that mark, and they'll tack on a penalty based on the amount you underpaid and the days you underpaid it, plus interest. For many retirees, that penalty isn't a minor slap on the wrist. It can easily exceed $500 or more, depending on your income and the gap in withholding. What makes this sting even worse is how invisible it feels until tax season. There's no quarterly bill arriving in the mail labeled underpayment penalty warning. And because retirement income often arrives in lumps, your IRA drip in March, a pension check in May, Social Security in June, it rarely lines up neatly with the IRS's January, April, June, and September deadlines. Even budgeting carefully for living expenses won't flag the fact that you've fallen short on your tax installments. By the time you file your return, the shortfall is baked in. Retiring early should feel liberating, not like stepping into a financial landmine. But without proactive planning, setting up estimated payments, tweaking your withholding on each income source, or running an annual tax projection, you'll wake up to an unexpected bill in April that could have been avoided. And that penalty, small or large, chips away at the security you worked decades to build. So, before you celebrate your first retirement anniversary, make sure you're paying your taxes as diligently as you once paid your dues at work. Uneven retirement income streams can sabotage your pay-as-you-go strategy before you even realize it's happening. Unlike a steady paycheck where taxes are withheld each period, your early retirement might mean a lump sum IRA distribution in March, a quarterly pension in May, and the first slice of Social Security not arriving until summer, and none of those payments come with automatic withholding unless you request it. That misalignment collides with the IRS's strict installment schedule: January 15th for the prior year, April 15th, June 15th, and September 15th. When your income spikes in a single quarter, you either have to guess how much tax to set aside or risk falling short of the 90% threshold the IRS demands. File those uneven streams into your retirement calendar, and it's almost guaranteed you'll underpay in at least one period, triggering the penalty even if you cover the total tax by April 15th of the following year. Social Security makes this worse. Only a portion of those benefits is taxable, creating confusion about how much to withhold, and any withholding you do elect gets applied only after your check arrives, which could be too late for the first deadline. Meanwhile, if your pension doesn't offer a clear withholding option, you might miss the chance to spread your liability evenly. Even savvy retirees who adjust withholding on one income source often forget to revisit each year's changing tax brackets, deductions, and credits. So a mid-year IRA rollover or a bonus for a 1K withdrawal can upend your carefully balanced plan. And it's not just the IRS penalties at stake. Underpaying can also lead to unexpected interest charges, compounding your cost until you finally make the payments. Next, we'll explore the IRS safe harbors and annualization methods that can rescue you from this uneven income trap. There's a way to sidestep the underpayment trap if you know the IRS's secret safety nets, safe harbors, and the annualized income method. First, the most basic safe harbor. Pay at least 100% of last year's tax liability, 110% if your AGI exceeded $150,000, or 90% of this year's liability through withholding or estimated payments, and the IRS can't ding you for underpaying. That means if you owed $40,000 last year, You simply need to pay $40,000 or $44,000 this year to avoid penalties, even if your retirement income doubled unexpectedly. But for retirees with lumpier cash flows, the annualized income installment method can be even more powerful. Instead of forcing equal payments every quarter, you calculate your actual earnings for each period. So, if you take a big IRA distribution in March, you match the higher tax payment to that quarter only. Then, when your income dries up for the rest of the year, your required payments shrink accordingly. You'll fill out IRS Form 2210, plug in your quarterly receipts, and show exactly how you met the paid-as-you-earn standard on your real timing, not the calendars. This approach isn't for everyone. Filing Form 2210 adds complexity and demands record-keeping, but for retirees whose income spikes at specific times, it can erase penalties entirely. Imagine retiring in January, taking a $100,000 lump sum March, and then living off small pension checks the rest of the year. With annualization, you make the bulk of your estimated tax in April and June, and owe almost nothing in September. Most early retirees never hear about these options because tax pros assume you'll stick to the simple quarterly schedule. But by combining safe harbor thresholds with annualized calculations, you can tailor your payments to the ebb and flow of retirement income and keep the IRS's penalty radar off your back. Yet there's one more hack that takes this strategy to the next level. There's a clever workaround that many retirees overlook: using your required minimum distribution at year-end to satisfy your entire tax installment obligation in one fell swoop. Here's how it works. When you turn 73 or 72, depending on your birth date, the IRS requires you to take an RMD from your traditional IRA or 401k. Normally, you'd calculate your RMD and receive that distribution by December 31st, but you can also elect to have taxes withheld from that payment. The key is that any federal income tax you withhold from your RMD counts as though you made an estimated tax payment for the fourth quarter. If you withhold enough, typically 90% of your total tax liability, or 100% of last year's liability, 110% if your AGI exceeded $150,000, you can meet the IRS safe harbor threshold without ever sending a separate estimated payment. Imagine taking a $50,000 RMD in late December and instructing your custodian to withhold $10,000 for federal taxes. That $10,000 automatically applies toward your required April 15th payment, effectively eliminating any underpayment for the first 3 quarters, which you can cover via withholding on other sources or small quarterly estimates, and wrapping the entire year's obligation into one action. Because the IRS treats withholding as if it occurred evenly throughout the year, you sidestep the quarterly deadline headaches and the risk of penalties, even though the cash physically only left your account in December. It's important to coordinate this carefully. You need to project your total annual tax liability accurately, work with your custodian to set the correct withholding percentage, and confirm that the distribution posts before the end of the calendar year. If your RMD isn't enough to cover your safe harbor amount, you can supplement with a small estimated payment earlier in the year, but many retirees find the RMD withhold-all strategy covers it entirely. The beauty of this hack is its simplicity. Instead of juggling multiple checks and IRS deadlines, you consolidate your tax requirement into the RMD you already have to take. Of course, this approach only works if you have an IRA or retirement account subject to RMDs, and if you're diligent about setting withholding rather than defaulting to zero. But for anyone retiring early and facing uneven income streams, it transforms a potentially complex puzzle into a single, streamlined move, leaving you free to enjoy retirement instead of tracking quarterly due dates. There is a little-known retiree waiver that sounds like a get-out-of-penalty-free card. But in practice, it's far from a reliable safety net. Under IRS rules, if you turn 62 in the tax year you underpaid and genuinely retired, you can request a waiver of the underpayment penalty by attaching a statement to Form 2210 explaining that your income change triggered the shortfall. It feels reassuring. After all, you're no longer earning a paycheck, so why should you be penalized for not having withholding set up? But here's the catch. This waiver is neither automatic nor guaranteed. The IRS evaluates your request on a case-by-case basis and requires a convincing reasonable cause narrative, meaning you must document exactly when you retired, show that your failure to pay stemmed directly from losing that income source, and prove that you took no opportunity or failed process wasn't due to oversight or neglect. Even then, the IRS can still deny your request, leaving you on the hook for both the penalty and accrued interest. Worse, because many retirees aren't aware that they have to file Form 2210 even to ask for the waiver, they miss the deadline entirely or fail to follow the specific waiver instructions. That misstep means the IRS will simply apply the penalty calculation by default, and you'll have no recourse. Unlike the safe harbor rules or the RMD withholding hack, which you can proactively use to avoid penalties, the retiree waiver is reactive and unforgiving. If you rely on it and find your waiver denied, you can file an appeal, but that drags penalties and interest out for months or even years, eroding your savings further and creating needless stress. In essence, the retiree waiver is a last-ditch option, not a planning tool. It's designed for truly extraordinary circumstances, think sudden disability or natural disasters. Not as a routine escape hatch for anyone who simply forgot to set up estimated payments. Rather than banking on a waiver, the smarter move is to understand your safe harbor choices, leverage annualization or the RMD strategy, and if you must, make small estimated payments early in retirement. That way, you control the outcome instead of hoping the IRS sympathizes with your retirement timing. Because when April rolls around, you'll want certainty, not another form to file, and a letter of explanation that may or may not save you from a penalty you could have avoided altogether. When you look back on your first year of early retirement, the reality can feel like a punch to the gut. What you thought would be smooth sailing, days of leisure, travel, and stress-free finances, turned into a scramble to cover unexpected IRS penalties, interest charges, and paperwork nightmares. You traded a regular paycheck for piecemeal pension checks, IRA drips, and Social Security splices, and that mismatch clashed with the IRS's rigid pay-as-you-go rules. By missing withholding on your final W-2, skipping estimated payments on lump sum distributions, or simply not knowing about the safe harbor and annualized income options, you opened the door to underpayment penalties that can easily top $500 or more for each misstep. Then you discovered the RMD withholding hack, only to realize it only applies if you plan carefully and coordinate premium amounts on a December distribution. And when you hoped for mercy from the retiree waiver, you learned it's neither automatic nor guaranteed, and often denied if your reasonable cause story isn't airtight. None of these outcomes is inevitable. Each penalty carries its own workaround, and each IRS rule can be used to your advantage. If you know exactly how and when to act, the real secret is planning. Projecting your annual tax liability as meticulously as you projected your retirement budget, mapping your income spikes to the IRS calendar, and lining up withholding or estimated payments before deadlines even approach. It's about treating your retirement income like a paycheck instead of a bonus, and treating tax planning as an essential part of retirement lifestyle, not an afterthought. So, before the next April 15th arrives, take a hard look at your tax picture. Plug your expected distributions into a tax estimator, explore safe harbor thresholds, model an annualized income schedule, and talk to your custodian about RMD withholding percentages. If you're within 2 years of turning 62, don't assume the waiver is your safety net. Use it only as a last resort. And don't let pride keep you from working with a tax professional who understands the nuances of early retirement income. Your goal was to retire on your terms, free from the fear of missing another work deadline. But the IRS isn't bound by your calendar, it follows its own schedule. By mastering these hidden rules now, you'll turn potential penalties into planned actions, protect your nest egg from surprise deductions, and finally enjoy the freedom you've earned. After all, early retirement should be about living more, not worrying more. Are you ready to close the loopholes before they close in on you? By now, You've seen how it felt like a seamless transition into early retirement can suddenly turn into a juggling act with the IRS. Penalties tacked onto your return, interest quietly mounting, and paperwork deadlines sneaking up when you least expect them. You traded a predictable paycheck for a patchwork of IRA distributions, pension checks, Social Security splices, and maybe the odd freelance gig, only to discover that Uncle Sam insists on pay-as-you-go, even after you've clocked out of the workforce. Missing withholding on your last W-2, or assuming your RMD would cover everything, can leave you facing underpayment penalties north of $500. Overlook the safe harbor rules or the annualized income option, and you'll pay for it. Skip the RMD withholding hack in December, and you'll still owe for each quarterly deadline you missed. And if you think the retiree waiver is a guaranteed out, think again. Without impeccable documentation and perfect timing, that mercy plea often gets denied, leaving you on the hook for penalties and interest you never planned to pay. All of these hidden traps share one lesson. Early retirement demands as much tax planning as your highest earning years did. It's not enough to project living expenses and healthcare costs. You must map every income spike to the IRS calendar, dial in withholding percentages on every retirement account, and if necessary, file Form 2210 to annualize your payments or calculate a safe harbor strategy. Treat your IRA distributions and pension checks like paychecks and run quarterly projections so you never wake up to an April surprise. If you're within 2 years of turning 62, understand that the retiree waiver is a last resort, not a planning tool. Better yet, consolidate your year-end RMD, withholding to satisfy your final installment in one move. And don't hesitate to enlist a tax professional who specializes in retirement income. They know these nuances and can save you more than the cost of their fee. Early retirement should be about more sunrise coffees than coffee-stained paychecks, more travel days than tax bill nights. By mastering these 5 IRS tricks, underpayment traps, uneven income pitfalls, safe harbor lifelines, RMD withholding hacks, and waiver realities, you'll turn potential penalties into planned actions. You'll protect the nest egg you worked decades to build, and finally free yourself to enjoy retirement on your terms. So before April 15th arrives, take a hard look at your tax picture, plug in your numbers, and act now. Because once that deadline passes, the only thing that won't be due is leniency.